Margin debt just hit $1.5 trillion. Should we worry or not? Let's discuss. Good day, everyone. Welcome to the video of the day. Right now, Americans have borrowed more money to buy stocks than at any point in the history, and the number is $1.5 trillion. The last three times borrowing spiked this fast was happened during 2008 financial crisis, during the dot-com crash, and the 2022 bear market. So, is this a warning sign or just noise? Let's actually get deep into it. What is called margin debt? The money investors borrow from their broker using their existing stocks as a collateral to buy even more stock. It can boost gains on the way, or it can go negative, it can make your money loss. Let's start with the number itself. In June 2026, FINRA, the regulator that tracks this data, reported outstanding margin debt hit an all-time high of $1.5 trillion. That's up by 77% over just the previous 14 months and roughly 50% higher than a year earlier. To put that into perspective, back in April 2025, during a brief market pullback, margin debt was sitting at $850.6 billion, and in a little over a year, it's nearly doubled. Now, the uncomfortable historical pattern is the point of discussion. Here's why this specific number makes analysts nervous. Over the last 3 decades, there have only been 4 instances where margin debt grew this fast, this quickly too. The prior three were all followed by serious market downturns. Margin debt jumped 80% in the 12 months leading into the dot-com peak in March 2000. Right before the S&P 500 lost 49% of its value and the Nasdaq lost 78%. Again, it surged sharply heading 2007 peak just before the global financial crisis, and it spiked again into October 2021, about 3 months before the S&P 500's peak, and followed a 19.4% decline through 2022. In all three of cases, margin debt itself actually peaked a few months before the stock market did, which is part of why some analysts treat as an early warning signal, not just a coincidence. Now, is this a case for panicking or it's not? Let's discuss. Here's the more balanced side of the story too, because the picture isn't quite as alarming as underlying numbers suggest. When you compare today's growth rate directly to those past peaks, it's actually lower. Margin debt's annual growth rate run close to 78% and heading in 2000 peak, 68% in 2007 and 72% into 2021. Today's growth rate, even its most recent reading, sits below all the three of those. That's actually way analysts measure this. So margin debt as a share of all overall economy. So at the 2000 peak, the ratio hit about 2.3. In 2007, it hit to 3% and the highest on record. And today, even with the record dollar amount, that same ratio sits at only 2.2%, below both of the last two cycle peaks. So by dollar amount, this is unprecedented. So by growing the rate and the share of economy, it's elevated, but not at the same extreme levels seen right before the last two major crash. Now everybody's asking that where is the money actually going? One market said that this offered a useful theory here. Individual investors' margin borrowing tends to flow into whatever part of the market has the strongest recent momentum. Right now, that's widely believed to be semiconductor and AI infrastructure stocks, which ties directly back to story we have covered before on this channel. The massive wave of AI infrastructure spending happening across the market this year. That's an important distinction. That isn't necessarily broad, indiscriminate borrowing across the whole market. It may be concentrated, but the borrowing chasing one specific very hot trend. Now let's look at the bigger picture. And here's where things stand. Margin debt just hit a genuine unprecedented dollar record, and history shows that every past instance of this kind of rapid borrowing growth has eventually been followed by a downturn. At the same time, the growth rate and the share of economy, the spike is still running below the last two major peaks, which means that the real risk indicator worth watching, but not now. On its own, proof that a crash is imminent. Now, to conclude, the honest answer is to should we worry or not. So this is a worth watching closely, but not panicking over. We'll keep tracking the number. If this help you understand number that sounds scarier in the headlines, then it might actually be the thing where you hit the button of subscribe. Make sure to like the video, share with your friends, family, colleagues too. Welcome to Money Brief. Let's grow together.